Okay, first presentation is about to start. I can't believe I've got that done in just 2 minutes because normally I'm talking for about 25. So I'm hoping that Lee Williams from Shawbrook Bank is now going to be added onto. There he is. Lee, morning.
Good morning, Tony. How are you?
I'm very well. How are you? Your sound's on, your camera's off.
Sounds on, camera's off, is that?
Okay. Yeah, your camera was on because you got a red top on.
Hang on.
There we go.
Excellent.
Right, so I will admit we've already gained 3 minutes, Lee, which is great news. So I'm going to immediately put you on and you fire away. Okay, cool. And I'll see you in about 15-20 minutes.
Okay, cool. Thank you, Tony. And good morning, everybody. Thanks, Tony, first of all, for inviting me back. It's my second Specialist Financial Services webinar today, so really, really pleased to be able to present to you. And here's me, again, looking slightly smarter than I do today, but I have got the corporate pink colours on today, so there's that.
Lee, my apologies. I mean, I've totally forgotten part of my job today, which you actually introduce you. So because I'm rushing through this like crazy. Apologies, everybody. I'm rushing through this like crazy today. So as you can see, everybody, you would have received. Lee, don't click anything because I've got to go through this. So you will receive this by email this morning. This is, as you can see, I think Shawbrook have now been 10 years. I don't know if that's 10 years since you relaunched. I'm trying to remember. Actually, it might have been.
It is, yeah.
Yeah, 10 years, or whether it's 10 years of Shawbrook, because you was previously Whiteway Laidlaw Bank, weren't you? So, so you've all been sent this morning. This is the new terms as of yesterday. Shawbrook very kindly decided to change all the terms yesterday, so we had to change a lot of what we were doing today. But still, it was all good news. So a little bit about Lee first of all. Regional Development Manager for Shawbrook Bank, covering East Anglia and Essex. He's been with Shawbrook for nearly 3.5 years, and prior to that has 30 years experience in financial services, predominantly with high street banks. Lee looks after 115 brokers in his region, helping with regulated and unregulated bridging, buy-to-let and commercial and semi-commercial investment mortgages. His speciality is working with brokers to shape large loans to present to their complex deal forum for an early stage board approval. And his interesting fact, and I did do my interesting fact today because I was trying to save time. Lee is a keen snooker player, which is part of a misspent youth apparently, and has won a couple of amateur tournaments at local club level and once played against a professional player. I do know from the last time he spoke, he lost. I can't remember who he said that it was he played, but yeah, he didn't win, unfortunately. So that's the end of his semi-pro career, I suppose. So Lee, now it's your turn. Again, apologies. Over to you.
Okay, it was Barry Pinches, who probably no one's heard of, but he was he got to the quarterfinals of the World Cup about 10 years ago. And he's still playing now, knocked out in the first round of the World Championships this week. Anyway,
there you go.
There you go. So, yeah, thank you, Tony. So, Shawbrook Bank, we are a specialist lender in the commercial property market. So, what does that mean? I think it means something different now than it did when we first started, as Tony said, 10 years ago. Back then, it was born out of the 2008 financial crash. A lot of the high street banks, or nearly all of them, withdrew from the commercial or from investment property markets and other sectors, meaning that there was a lot of sectors that were unserved. So Shawbrook was founded 10 years ago to serve those unserved clients. And back then, anybody who did a limited company loan to a property investor would have been called a specialist lender. But now pretty much all of the lenders in our space do that. So I think now it means something a lot more, and it's more about those kind of professional property investors that have large portfolios where the more vanilla lenders perhaps have reached their exposure, or maybe it's the more niche opportunities that these investors find that just simply don't fit with those vanilla lenders. So to serve the unserved clients is really our mantra that's continued all the way through. And our client profile is very much still professional property investors. And we only lend via specialist brokers, specialist intermediaries, such as specialist financial services. Specialist is a word that you're going to hear a lot today, I think. So what's next for the specialist lending market? So there's no doubt COVID-19 has definitely changed the shape of the property market and the way that investors transact. We've seen restrictions in lending options for investors. Shawbrook have continued to remain open throughout lockdowns 1, 2, and 3 and continue to lend. In fact, we've had record years in terms of completions and getting money out the door, primarily probably because we kept our doors open and we're still lending when others closed the doors for a while. But there's always been market liquidity, so this is very different from the 2008 crash where there was just no money to be lent. There's still money awash in the market and money to be lent. And confidence is slowly returning to the market with lenders coming back in, which is great for competition and great for confidence. But there still remains an opportunity for specialist lenders to fill the voids that high street lenders leave behind. And we're seeing that more and more. So the role of the specialist lender and the specialist brokers are going to become ever more important as we come out of this. The good news is that the government have supported the property market. So we've seen them give the stamp duty holiday, which has now been extended, which is helping. And we've seen the property prices continue to rise. And again, that helped to drive record numbers of applications last year for us and for other lenders as well. We did see the minimum affordability standards that the Bank of England set restricts gearing for landlords. So by that, we mean the PRA standards. So lenders have to assess the outside portfolios of clients to make sure that they meet the minimum standards, and that can sort of restrict investors' gearing. So investors are having to look at ways of diversifying their portfolio, perhaps to increase yield rather than rely on the growth in value of their properties in order to keep their portfolio manageable and still be able to borrow to grow their portfolios. We're also going to see a change in views in commercial assets. So the big sort of serviced offices, are they still going to be needed? Are they still going to be used? Or are the investors who own these assets going to look to change them potentially to residential assets? It remains to be seen how things are going to pan out in terms of people returning and transitioning back to the office. Interestingly, I'm involved in a forum for Shawbrook where we're talking about that subject in terms of being flexible and using a hybrid approach where staff can return to the office, but probably not full time. The kind of feeling at Shawbrook is most people are quite happy working from home and more productive because they haven't got the commute. But I think my personal view is as confidence grows and the vaccine rollout comes, people might well start to gravitate back to city centres and back to offices because of we're humans, right? And missing the human interaction, I certainly know I've missed that. So refurbishment and development might become a smarter option for creating value, as I just said. So either people buying houses and refurbishing them and selling them, or perhaps converting into houses of multiple occupation and then keeping them and building a portfolio that way, which are good yielders. Developers, we're starting to see a trend where they're perhaps holding onto them for short or mid-term investments because they can see that the prices are going up, or perhaps the market means that they just don't want to sell at the moment. We're also seeing a change in trend where people are moving away from short-term ASTs and securing longer 3 to 5 year corporate lease agreements, perhaps with local councils or housing associations or even charities where they're perhaps housing vulnerable tenants. Prior to this, Shawbrook and other lenders would always shy away from vulnerable tenants, but where you've got a reputable agent that's the tenant, and we can do due diligence on them and know that they're going to be able to take care of the property and look after the tenants, providing there's no sort of on-site care given and it's not, arguably a care home, then we can consider those longer-term corporate leases with those kind of agencies. We're seeing a change in technology with significant developments that's going to benefit clients and brokers. So we've invested around £4 million in the last year on a new buy-to-let hub, which is being trialled right now with some of our brokers and will be launched in the next few weeks, along with things like e-signature, which will speed up the process from getting to offer to completion. I think we're going to see this with other lenders as well, but what we recognise is that you need to get the balance right between technology but still having the experience and the expertise of a human pair of eyes that's able to make decisions based on their experience and the deal itself, rather than a computer says yes or no mentality, which is definitely not what we want. So speed and efficiency in the customer journeys is definitely going to help with these technology improvements, but we will never go away from having somebody look at every case and make sure that the right decision is reached, even if it doesn't quite meet our criteria. So using specialist lending to maximise potential. The key thing that I recommend is getting to know your contacts within these specialist lending market. So as RDMs, our role is really to manage relationships with our brokers, to be the first point of call if they get a case they want to run past, to see if it fits or not, and to liaise with the underwriters. The underwriters at Shawbrook are all experienced. They're all human beings. We can talk to them. Brokers can talk to them. And there's nothing better than a broker being able to chat through a deal with an underwriter so that they understand it, rather than just what's keyed over the computer. And we really value that relationship. For developers, bridging used to have a bit of a stigma that it was expensive and it was the sort of last resort form of lending. But more and more professional property investors use bridging as a means to maximise their opportunity and maximise their profit, because it means that they don't have to wait so long to go again for the next project. So bridging is used as a smart tool for property investors, making sure that they can move very quickly and efficiently. I've already spoken about the longer term lease agreements. We're seeing semi-commercial and commercial landlords wanting to diversify their portfolios. So with the relaxation in planning laws, making it easier to turn commercial property into residential, using permitted development, that's definitely an opportunity going forward that we think we're going to see investors shifting towards. And our bridging product certainly lends itself to that, where somebody can do a bridge to purchase a property, arrange the change of use and do the refurbishment, and then switch to term for just half the arrangement fee on the term exit. A really popular product that we do there. But there's definitely going to be more and more demand and not enough supply at the moment. So demand will increase, which will definitely have a positive impact on the landlord market. So positive news there. So Shawbrook's proposition, as I said, we're committed to supporting landlords and SMEs with property transactions. We work very closely with our intermediaries across the UK. We don't have an open panel. We value the relationship we've got with a select number of introducers and intermediaries, and that has created sort of long-term relationship with those intermediaries. As I said, we have specialist expertise in terms of me, our underwriting team, and all the staff that help get the cases through to completion. We pride ourselves on having very simple product range, which has been born out of the last 10 years experience, really, in terms of being innovative and creating solutions that meet the needs of our clients, the property investors. We're also very transparent with our criteria. It's available to our brokers on our broker hub, and so they can see exactly what the underwriters underwrite to. And we also, as I said, recognise the importance of achieving the balance between people and technology. And because of that, we've won multiple awards for our products and our services over the years, which we're very proud of as well. So I'm here today to talk primarily about commercial and semi-commercial investment. And this is brilliant timing because, as Tony said yesterday, we announced that we were reducing our rates by up to 0.3% on our commercial investment products, which is great news. These slides don't reflect that. But on semi-commercial, our variable pay rate is now reduced to 5.19%, up to 65% loan to value, and 5.69 on pure commercial investment loans, up to 65% loan to value, or up to 65%. So a good reduction. It puts us in line with some of our competitors. We may be a bit more expensive than some of them, but the terms we can offer usually mean that the client would pay a premium to receive our terms. And what do I mean by that? Well, our loan size starts at 50,000. Many of our other competitors in the market will have a minimum loan size of probably 200,000 or maybe 100. We can lend up to £25 million, and we can lend up to 25-year interest-only terms. So the more vanilla lenders or the high streets definitely would probably want capital and interest repayment rather than interest only, which means they'd struggle to get anywhere near 75% loan to value. They probably would also only want to lend to the term of the lease, or maybe a 5-year term as a maximum, so that they can review their appetite, which means that the client's got uncertainty. They're definitely going to have to pay another arrangement fee, and they might need to pay another valuation fee. And if it's a high street bank, they may well need to rebank their whole relationship, which again is a big sort of concern or uncertain times for the investor. So being able to offer a 25-year interest-only term helps us win lots of deals, but the client after 5 years can walk away without any early repayment charge. And moreover, if they if they want to do a refinance with us at any point, then we would waive the early repayment charge to help them enable to take a new loan out with us, repay the old one, and change something fundamental or capital raise to raise a bit more cash out of the property that we've got a charge over. So that flexibility really helps. So somebody could be on a 25-year interest only term. They could have a 10-year fixed rate product with us, and on year 5 can walk away without any break fees or any early repayment charges. We've also got a complex commercial product. So this is a really interesting product, which is for those kind of scenarios that just don't fit anywhere in the market. So things like vacant commercial, where perhaps somebody's buying a vacant building or a lease that's running down to perhaps get planning gain, or maybe they want to change the use of the property or convert it into offices and let on short-term licenses rather than on fully repairing leases. So again, there's not really anybody in the market that looks at those kind of deals. Together used to do them, but they were around about 8% rates. So we're at 6.4% on that complex product. It is just a 5-year term available on that one to enable us to get it in the door and have a look at it for a few years, and then hopefully switch to commercial investment once it's up and running, which would be a cheaper rate for the client. So a really interesting product. There isn't really a definitive list of what fits on it, but it's one to run past us and see whether we can look at it on that product if it doesn't fit anywhere else. I'm going to finish on a case study because everyone loves a case study. So this was a deal that we did for one of our other intermediaries. They were looking to secure funding for a vacant office building in Watford. I think it was a mother care building, and also a PRS apartment scheme in Kent. They came to us last April, which was fantastic timing, which is when lockdown just started and many lenders shut their doors. They required a total of 13 million and 9 million. And the two deals came to us, as said, in April, when other lenders were struggling with the implications of COVID. Both our commercial and our bridging team, along with the broker, worked tirelessly despite the challenges to ensure that we got the funding they required. And from first contact, the case was completed and funds were released within 2 months. So the client was delighted to get both properties, especially during that climate, which held a huge amount of potential for them. On the PRS scheme in Kent, we provided a £9 million loan on interest only fixed for 5 years. And with the vacant building in Watford, we did a bridge on interest only for 12 months to enable them to secure that. So a really good example of us working on in difficult times to get a deal over the line really quickly. So last of all, here's my contact details, but I'd encourage you to put any inquiries you've got through to Tony and the team initially, because they're fully aware of our criteria and can provide illustrations and indicative terms. But my contact details are also there.
Okay, haven't got any questions. Lee, thank you very much indeed. Haven't got any questions. So I've got, so everyone knows what we always do, just in case there isn't any questions, we always ask the presenters to come up with some questions themselves. So hopefully, if any of the presenters today can't answer one of the questions, they've actually written the questions themselves. So just remember that. So Lee, question number 1, no pressure. Yeah. Are Shawbrook still lending across all commercial investment sectors?
Well, that's a great question, Tony. Yes, we are. Yeah, all through this, we've never withdrawn from any sectors. I would say that we are still lending up to 75% loan to value. In certain sectors, we may restrict lending to 65%. For instance, if you've got somebody doing their first commercial project, the capital raising maybe on an unencumbered property, and they haven't got much experience, we're probably going to limit loan to value. But if it's a strong client with a strong asset and the tenant's been performing well during the lockdown period, there's no reason why we can't go up to our maximum loan to values, and that hasn't changed all three.
Okay. Question number 2: are you seeing a shift from people investing in buy-to-lets from buy-to-lets to semi-commercial, commercial and property investment?
Yeah, as I mentioned in my slides, really, we do think that's an opportunity where people are looking to diversify. Having a tenant that's going to maintain the property and hand it back in the condition it was when you gave it to them is attractive, and looking after the maintenance, but also the opportunity to convert semi-commercial into residential and provide extra growth and yield that way is attractive, and we're starting to see a lot more of those kind of applications coming our way too.
Okay. Question from, I'm going to try and get to all these questions, by the way. So question from Joe, when will you be able to consider owner-occupied commercial premises?
Yeah, that is a really good question. That is one thing we did restrict during COVID. And it's something we're banging the drum about really loudly at the moment, because we're seeing some really good opportunities in that owner-occupied space, which we just can't look at the minute. Haven't got a definitive date at the moment, but I know that the managing director of our team in commercial property is, constantly talking to our board to enable us to get that back. So I don't think it'll be long, but I can't tell you a date as yet, I'm afraid.
Understand. Ahmed's asked the question, I run a small DA firm. Can I access your products directly?
Well, as I said in my slides, really, we have a limited panel, which is closed. So initially, we would want you to go through one of our broker partners. We're quite happy to talk to brokers and discuss deals, but initially, what we're looking for really from our broker partners is experience in the market, good levels of packaging quality, and an expectation on levels of business. So until we can see that, we would direct them to people like Specialist Financial Services to handle their cases.
Okay, and obviously, just from my point of view, I know of many people we quite often get people phone us and say, I've got a commercial deal. I've never done a commercial deal before, but I want to try it and see what it's like. Now, that's the worst nightmare for any lender, as you can imagine. When someone is practicing on how to do a commercial deal, it's always best. I mean, we've had people come to us before, they put 4 or 5 through a particular lender, and then they've gone to the lender and said, I've given you these deals, and they've then managed to get on board.
Yeah.
So, I mean, we don't have a problem with that, because it means that we earn obviously out of it for a time period as well. Yeah. But I think from any lender's perspective now, just ensuring that the distribution is kept so that they're not having their staff tied up with people. I remember some years ago, it was Aldermore decided to launch out to every broker that had a consumer credit license, and all of a sudden had 13,000 brokers on their database. And they had brokers phoning up their commercial underwriters asking what a lease was.
Yeah.
Their inbound call volume increased by 900%. So I know many lenders sort of learned from that situation, and you're trying to avoid it at all costs, because there are, unfortunately, it's like me deciding I want to start writing pensions. I get qualified. I want to start writing pensions. I'm never going to do that, by the way. I wouldn't have a clue what I'm doing. Not a clue. So very much the same with many lenders now. They're very much about just trying to keep it slick, trying to make sure their underwriters aren't taking up too much time on each case. Is absolutely vital for them. But if it's something you want to get into, Ahmed, then by all means, give us a try. And then you have my word, after 5 cases with Shawbrook, I'll be phoning Lee saying, Ahmed's good to go, take him on direct. So there you go. You got my guarantee. Anton Rex has said, this might be a bit of a difficult one for you to answer. Is there any lender for first-time buyer semi-commercial property? I can't remember actually your terms, Lee, because I don't know the terms of every lender we do.
So for semi-commercial and commercial, we did relax our experience criteria. So before, we would have wanted somebody to have 5 buy-to-lets in the background before they could do commercial property, but we've relaxed that now. So all we really need now is somebody to have 12 months buy-to-let experience. So it can be just 1 buy-to-let for 12 months, and then 2 years on the commercial lease, or 2 years until the next break. So whilst we can't do first-time landlords, it's much easier now than it used to be to move to your first commercial and semi-commercial.
Okay, and Rex, there are lenders that will do that, by the way, but they do tend to be slightly dearer. Everyone likes the Shawbrook, as you can imagine, because there's less competition. So the less competition there is, the higher the rates, unfortunately. That's the way lenders work. Okay, Lee, you're 4 minutes ahead of time. Absolutely fantastic. My surgeon will thank you enormously. So I will see you the other side. I will see you, no doubt. Lee's been our BDM now since last year. We've not actually met face to face yet. We've done at about half a dozen Zoom meetings. Haven't actually done a face to face. So maybe he'll be the first hand I shake in 13 months.
Yeah, that's.
I worked out the other day. I've not actually shaken anyone's hand in since March last year.
It's just nice to see the bottom half of people, wouldn't it, rather than just.
Yeah, it will be. Yeah. I won't comment on that at the moment. To be honest with you. Anyway, right. Lee, thank you very much. I'm gonna let you go. Here you go. This is who we're expecting to turn up any second now. Yeah, there she goes. She's coming on board now. So exactly the same hairstyle, I've noticed. Was that photograph taken this morning, Pauline?
No, it wasn't actually. A couple of pounds heavier as well.
Blimey. Okay, so yes, our next speaker, Pauline Rylands from West One Loans. This is the second charge side of West One, as opposed to the bridging or the buy-to-let side. See our future shows for both of those. First of all, this is what you've been sent in by email this morning. So this is their product guide as of March 2021. This is up-to-date stuff. West One, since they launched, I think it was 2017, they launched into the second charge side, have been something of a revelation, because the people behind it are basically former brokers, pretty much. So they know, first of all, they know what to look for. They know what brokers want, but they also know all the tricks of the trade and what brokers are trying to get away with in the past. That basically, but they are a very, very good lender. We do tend to place a lot of large size deals with them. They are very, very good for that sort of stuff. The 300-400 granders, especially. So a little bit on Pauline, first of all. 35 years experience in financial services, previously holding senior management roles in the branch network of Yorkshire Building Society, where she worked for over 31 years before joining West One. As a key account manager, Pauline manages broker relationships and regularly presents at intermediary events to promote the benefits of second charges, hence her being here today. Her claim to fame: Pauline was once an extra in a film called Going Off Big Time, which I then Googled yesterday to see what it was all about. I recognised two of the actors. I think it was a crime film based in Liverpool. That's right.
That's right.
You didn't get any credits, Pauline. I did check.
No.
There's no credits whatsoever. So we're going to have to take your word for that one. It is apparently, if any of you are really interested, it is available on Amazon.
This is true.
Yeah. So I might, seeing as I'm probably not going to get any sleep tonight, I will probably see if I can find Going Off Big Time on Amazon Prime. So let's see how I get on. Anyway, so Pauline, it's going to be over to you now, and I will see you in about 20 minutes. We're bang on time, which is good.
Brilliant. Great to hear. Okay, so hi everybody, and thank you for your time today. So what I want to do today is to give you an overview of West One secured loans, and also talk about how the pandemic has affected your clients. Try and give you some information on what a second charge mortgage looks like, and also when a second charge might be best practice for your clients. I'd like to highlight, above all, that a second charge mortgage is not just for adverse clients or for those who have problems. And I'd like you to leave today thinking, which is the best mortgage for my client, a first or a second? So West One Loans is part of Enra's Specialist Finance Group. We started as a bridging lender, moving into development finance not long after. As Tony quite rightly said, we started a soft launch in 2017, started our venture into secured lending, and we quickly earned our place amongst other lenders. And we've continued to grow. Our market share is quite big now, which is brilliant. And we've recently moved into our buy-to-let first charge market, and again, that continues to grow. We moved into that last year. As you can see, we're fast becoming a lender who can not only start your client on the journey, perhaps with a bridging loan, but we can support them with an exit strategy to make the whole journey an awful lot smoother. West One, we're a non-bank lender with excellent funding lines, and this allows us to be more agile and adapt to the changing market more quickly, as we've proven certainly over the last 12 months. Each of our products, as mentioned, can be accessed via specialist financial services, and I'll talk a little bit more about that in a bit. So what impact has the pandemic had on the mortgage market? Well, you as a professional advisor have never been more important to your clients during such a worrying time. The process of obtaining finance has become more complex due to lenders adjusting their approach towards credit risk during these uncertain times. It's even more critical now to review your client's circumstances to ensure you're putting them in the best financial situation. And we're seeing much more restrictive criteria for self-employed clients and first charge lenders increasing their requirements and making it less likely for your self-employed clients to obtain a first charge mortgage. As you know, with regards to debt consolidation, more first charge lenders are turning borrowers away. Okay, so why is second charges so relevant to you as advisors? Well, in December, we formally introduced the Bank of Mum and Dad, and this was to support the first-time mortgage market, first-time buyers to get onto the property ladder. Parents or grandparents can raise funds by way of a second charge mortgage on their own property and gift the funds to their child or grandchild. This would give them a bigger deposit and possibly a lower rate. By retaining the conditions of the first charge mortgage, a second charge could support with the necessary home improvements and even debt consolidation, as I mentioned before, which could put your clients in a much better financial situation. Not only can we support your residential clients, but we can support your property landlords with a competitive range of products also. And that's whether or not they do that on a full or part-time basis. And during the uncertainty of the pandemic, we've seen more clients take up the opportunity of longer term fixed rates, and most doing this by way of a product transfer rather than a remortgage, therefore locking them into a product and unable to raise funds for the fixed rate period. So the latest figures we have from Q4 last year confirm that product transfer volumes were 4 times higher than a remortgage transactions. As you can see from these figures, remortgaging was down by 37% compared to Q4 2019. There were over £168 billion worth of product transfers in 2020, and we saw a peak in August when almost 85% of refinancing was done as a product transfer. With a lot of high street lenders contacting your clients prior to the fixed rate coming to an end, it's likely that these were done on an execution only basis, meaning they potentially bypassed your advice to complete the transfer. This could leave your clients in a position where they're unable to access any funds by simply using a first charge lender as an option, and a second charge could bridge this gap and protect your client bank. So where previously you would have had the opportunity to regularly review your client's circumstances and remortgage them to a new lender every couple of years, the increase in longer term fixed rates and execution only product transfers, where your client may have bypassed your advice, as I said earlier, has removed this line of business from you. Considering a second charge as you would a first charge will enhance your product proposition and retain your client bank where your client is unable to raise funds for their first charge lender. You have the support of specialist financial services to look after your clients and allow you to concentrate on your core business. And as you're aware, any broker with independent in their title must consider second charges alongside a remortgage option. So from an FCA perspective, this could be best advice. So looking at some second charge opportunities, taking a second charge could allow your clients to leave their first charge mortgage terms intact. They could be on an interest-only mortgage, or they could have onerous ERCs. They could also have had to change in their circumstances since taking on that first charge mortgage. They could now be self-employed, or they could have had some issues with their credit. A second charge gives flexibility in respect of the term and the loan purpose, and in some cases, a loan purpose that a first charge lender would not consider. A second charge is much quicker to arrange and could ensure your client meets a particular deadline. We don't have post-completion conveyancing issues that you will find with a first charge. The money is normally in the account the following day. We've had cases where they've been in the morning, they've been worked by the underwriter, and we've issued the offer by 12:20 that day. And that's a specific case that came into us a couple of weeks ago. We'll consider many options that a first charge lender won't. A client who is married, but the first charge mortgage is in their sole name, they can proceed with it and the second charge in their sole name, or they can add their spouse or partner onto the second charge, making the loan more affordable. First charge lenders tend not to like loans that involve debt consolidation, but that's just not an issue for a second charge loan. So if we look here at this particular scenario, this is a client who's on an interest-only mortgage with £300,000 outstanding, and they've got a really competitive rate, 5-year fixed, of paying 1.75. The current monthly payment is just over £437, but they're looking to borrow an extra £50,000 for home improvements. To take a further advance, it would have been allowed, but it would be conditional on all of the borrowing being converted to a repayment basis. This would increase their payment by over £1,400 a month, and that's based on a 20-year term. So you can see how the additional borrowing of £50,000 will cost them virtually an extra £1,000 a month. The other option is to take a second charge. The borrower leaves the interest-only mortgage in place, so retaining their mortgage payment of £437.50, and they take a second charge for the £50,000 at a rate of 4.25 on a repayment basis, again over 20 years, and their payment here is just under £310. So you can see that the total payment that they would make is just over £747, saving the borrower just under £664. So you can see how competitive that is. You can also see here from the range of products that we have variable and fixed rate options that start at 3.99. And we've more recently, in March, moved up to 85% loan to value on our products. And that's for employed, self-employed, and for retired clients also. And with that, we don't have any restrictions. The products that we offer and the products that we display and the criteria are available for employed, self-employed, and retired applicants right up to that 85% loan to value. From an affordability point of view, we'll also look at using 100% of regular overtime and commission, which will also help and make the loan more affordable with West One. And our affordability, I think the biggest plus is our affordability is based on automated expenditure. So we also have no LTI restrictions on majority of our products. And that can certainly help. So we can go above 6 on our Apex One range, which is a big help to your clients. And as Tony said before, is often your bigger loans, your clients perhaps with a lot of equity in the properties, we can certainly service those. Our loan sizes are up to £500,000, up to maximum LTV of 65%, but we will consider larger loans on referral. We also have loan terms from 3 to 30 years. And we also have our loan purpose, a wide range of loan purposes from debt consolidation, home improvements. We'll also look at raising for business purposes and to pay off tax bills as well. Older borrowers are catered for. We don't have a maximum age at application, and we can actually go up to the client's 85th birthday as long as they have something in place for when they actually retire. And we have bespoke underwriting. I think this is more important, that we don't actually credit score, so we treat your clients as an individual. So at West One, we don't only offer residential products for your clients, but we also offer a competitive buy-to-let products that will support your landlords. From clients wanting to do home improvements to improve the rental yield or the property value, or increasing their property portfolio by raising either a deposit or the full amount for the property purchase. They can also raise funds for personal use, so for home improvements on the residential property or to consolidate debts. So you can see here the case study that we've used. We have a professional landlord who is looking to add to their property portfolio and they're wanting to raise £150,000. They've got excellent rate with their existing first charge lender, so that was really probably inappropriate to do. And our borrowers have an extensive property portfolio, which are all self-financing, and they could also explain and demonstrate that they had funds available should they need to cover any rental void. The solution here was for a second charge with West One loans for £150,000 at a rate of 5.99 on an interest-only basis, and the exit strategy in this situation was sale of the buy-to-let. Okay, so as you can see with the products that we have here with our buy-to-let range, West One is one of the only few lenders who offer buy-to-let second charges, and we've got market-leading products that start from 5.99. The range, again, we have variable 2 and 5-year fixed rates up to maximum LTV of 75%. And we also include consumer buy-to-let within that. And again, one of the only lenders that does that. Our loan sizes are between £10,000 and £250,000. And our affordability is based around the debt service cover. And we'd use that, the lower of the AST or the rental assessment from the valuer. We have interest-only options available for terms up to 25 years. And also portfolio landlords are catered for. As long as we can see that they're on a standard AST and the self-financing, we don't need any further information for the products, for the portfolio that sits in the background. We'll also consider licensed HMOs and expats by referral. We don't cross-charge at West One, but what we can do is up to 3 loans per borrower. And it's, Marie hasn't updated the figures here, but basically it's up to £750,000 now. So again, a big difference there. Okay, so hopefully today has given you some further ideas on how a second charge can support you and your clients. And I hope you can see how second charge can be best advised in certain circumstances, how it can protect your client bank by offering a broad proposition. And above all, I hope you start to consider what mortgage is best for your clients rather than seeing a second charge as a last resort. We don't expect you to be experts in second charges, and that's where specialist financial services comes in. and they will allow you to concentrate on your core business whilst looking after your clients. The distribution of our products is just through our master brokers, and we're proud to be partnered with Specialist Financial Services who can look after all you need for your clients as well.
Pauline, thank you very much indeed. We've absolutely flown through that. My goodness. Absolutely brilliant. Blimey. Okay, there's no questions from, someone's typing, but I've got, these are some questions that were set previously. What are the real opportunities for second charges at the moment?
Well, certainly, as I said in my presentation, self-employed borrowers, we're seeing far more restrictive criteria with first charge lenders. And I think it's fair to say, and it's been reported back to me, that we're so flexible with self-employed applicants in the criteria that we need. So we look at 2 years SA 302s plus the tax year overview, and then a letter from the accountant confirming the projected earnings for 2021 for the client. So in most cases, there's really no need for even bank statements in that situation. Also for debt consolidation, again, first charge lenders not wanting to lend for debt consolidation, and they'll avoid it like the plague. For us, it's probably the majority of our business that we do. A client's changing circumstances, we see that a lot. So as I mentioned at the beginning, a client who's taken a bridge perhaps in a situation where their circumstances have changed and therefore their exit strategy is not appropriate anymore. And is basically not available to them. And we can look to service that. And we've done quite a lot of that this year, to be fair. Due to the pandemic, properties not being sold, which was the exit for the bridge. And basically, we've sorted out a second charge for those clients and got them out of a sticky situation.
Okay, Georgie has asked the question, some first charge lenders will not give consent for second charges to be registered, i.e. Paragon, on their buy-to-let. Can you still help?
Unfortunately, not at the moment. We do need consent from the first charge lender. We pulled equitable charge when we went into the original lockdown, and we've not brought it back as yet. But keep on telling me you need it, and I'll keep on feeding that up the chain.
Okay, George, just so you're aware, we do have, I think, one, possibly two lenders that will allow an equitable charge, so they don't require the consent of the first mortgagee. But now that Pauline's heard that, no doubt she'll be on the phone to her bosses immediately to tell them
probably
that
daily at the moment.
Yeah. It will be back. Paul Rhodes has asked, how are valuations done? I can probably answer that, Paul, because the valuations, as we are the packager as such, or we're the ones with the agency on the second charge side, this is the same for all second charge lenders. We instruct the valuations in-house ourselves, so we decide on which valuer to use. We've got great relationships with the panel valuers that most second charge lenders have, and it's dead simple. That's always been the case, because up until about 4 or 5 years ago, we had to pay for the valuation fee in every single case. That's not the case anymore. It can now treated the same as a first mortgage. So that's basically, yeah, we instruct them, and we've got different firms that we use. So we tend to get an incredibly good service out of them. Someone else is typing, but I'm going to ask you another one. So Pauline, why can't I, this is not me personally, but why can't I not submit second charge applications direct to West One?
Yeah, so basically our products are distributed exclusively through the likes of yourselves, Tony, for the simple reason that we have a small team and we don't have the resource to be able to go direct to borrowers at the moment. You quite rightly said after the previous presentation that it really is about the expertise. You're somebody who knows our criteria and exactly what we need on day one to package the case. We look for the cases to come in and go out the door, ideally in the same day. Not always possible, but certainly within a week. And that is what supports the speed, is the likes of yourselves being the experts in this. Quite rightly, people will often say, well, I'm authorised to give advice on a first charge basis. It's a completely different matter, as we all know. It is specialist lending, and it's called that for a reason.
Yeah, and the other thing is, you're our key account manager. We're based in Hertfordshire. Where are you, Pauline?
I'm in Liverpool.
There you go. You might from that just guess that maybe Pauline might be the sole key account manager at this moment in time. If they took in 10,000 brokers, unless they start cloning Pauline in some way, which you cannot get round to everybody in 20 years, let alone. So it's purely. But if you do want access to these products, I'm not going to be talking about it later because we haven't got time, but I would normally talk about it and watch the next show if you want to find out more. But just very briefly, we allow our for those that have the right permissions, and if we're happy for them to do so, or happy for you to do so, we can actually allow you to give the advice, and we will do the packaging, and we don't charge any fees. There's no packaging fees whatsoever. So whatever you decide to charge is what you earn. On the bigger deals, we even give a slice of the commission away as well, the prop fee away as well. Normally anything with Westbourne, I think it's anything over about 75 grand. So yeah, if you want access to them, you can have access and not lose control. So that is available. Again, it's very much it's a decision that I make once I decide, because obviously it's my agency on the line if I'm not happy with who's given us the business. So okay, one last question. There was somebody typing something that hasn't come up. What demand are you seeing for second charge finance at the moment, and is this specific to a certain type of borrower?
Consolidation loans, as I said earlier, tends to be the main loan purpose. We're also seeing a lot at the moment to pay off tax bills. We've kind of struggled to get comfortable with tax years from the current year, or tax bills from the current year. But I think the revenue has been extremely good with most clients. So if your client is in a difficult situation and has struggled last year, as long as they've got the affordability now, then we can look to pay off that tax bill. Bank of Mum and Dad, which, as I said before, we launched back in December to support the first charge market. We do lots of that where parents or grandparents help their children or grandchildren out by basically gifting funds to them. And we see loans in excess of £250,000 for that purpose. There's no ILA required. It's a straightforward transaction. So they raise the funds on their own property and then gift the funds to their child or grandchild. So that's becoming more and more popular.
Okay, right, we don't have any more questions. So Pauline, thank you very much indeed. Absolutely brilliant.
Thank you.
You give me another, actually give me 10 minutes on this one. This is great.
You might need the toilet, Tony.
May well do. I'm not allowed to drink anything can't drink anything from 10:30 onwards. So if you see me guzzling water on screen, that's the reason why. I'm just trying to get as much down me as possible.
Good luck. Hope it goes well.
Yeah, nothing serious, but it stops something that might be more serious in the future, hopefully. So, but nothing I'm concerned about. But just means to get a day off work. Pauline, thank you. Right, Pauline's gone. So our next presenter is lovely Grace Bennett from Family Building Society. You should have received this morning this quite funky bit of marketing from Family Building Society with all sorts of different, obviously different types of customer. Potentially that could be, well, it's old, the granddad, a little bit more trendy than you probably should be, or the guy with a very funky beard and haircut. So that should be with you this morning. Take a good read of that. Just before I do the next, but just to let you know that we are an accredited packager for Family Building Society. Got some absolutely fabulous products. So this really is one today that for any of you that are in the mortgage broking side, please watch this one carefully, because there's stuff that they will do that no one else will touch. So, okay, so a little bit about Grace. Grace has been working in the financial services industry for 4 years now. Hobbies include socialising, travelling to new places, and binge watching the latest thriller series on Netflix. I've actually done all of Netflix, I think, over the last year, which, as you can imagine, takes up quite a bit of her free time. She also loves meeting new people, which is why she enjoys her job so much. She's probably sick of looking at a screen, meeting new people at the moment, is desperate to actually get out. We've not met yet. We've not met face to face, but we've got loads and loads of like Zoom meetings and other bits and pieces. Grace, by the way, can you hear us? We can't hear you. I can't hear you, which isn't a good sign. Right, okay, I'll just then very, very slowly read her interesting fact. Keep trying, Grace. Keep talking until we can hear you. So Grace has completed a skydive over the Palm Jumeirah, hope I pronounced that right, in Dubai, the most amazing experience of her life. Okay,
Can you hear me now?
Yeah, I can hear you now. Great. Okay.
Brilliant. Oh, that's good.
There you go. I thought I was going to lose me 5 minutes straight away. Right. Okay. So Grace, over to you. We'll see you in about 20 minutes.
Thank you so much. So yes, as Tony introduced me, my name is Grace Bennett and I'm one of the BDMs at Family Building Society. I have been with the society for actually 4 years now, and I was originally in our BDM support team, and then I took over from Charlotte Grimshaw, who some of you may know, as a BDM, and I mainly look after west of the M25, but mainly focusing on the postcodes GU, AL, HP, RG, and SL. But you know, we have 5 other BDMs up and down the country who look after those areas, but we also have a dedicated BDM support team as well in head office to help any of your inquiries in our absence. So I'd always say certainly use them as well. I will be just giving a little bit more background about Family Building Society today for those who haven't used us before, and also then just go through our general criteria and USPs, but I'll be focusing a lot on buy-to-let lending as well today. But I'll also touch base on the other areas of residential lending that we do focus on really quickly, just so I can give you guys an insight of what we do there. So yeah, we're previously known as National Counties Building Society. We rebranded at the end of 2016 to Family Building Society, and the reason for that rebrand is we wanted a name that, you know, really reached and focused a lot on the areas of lending that we were trying to approach. So we do a lot of intergenerational mortgages, and we lend to first-time buyers, those clients into their 90s, and that does apply to buy-to-let lending as well. So our minimum age is 18, but as it says there, we'll go to age 90 for those clients. Other areas of lending that we do focus on as well is largely in lending into retirement. We've got those interest-only mortgages, mortgages for expats, and then we've also got a joint borrower, sole proprietor, and 95% family mortgage. Okay, so what I think makes us most niche in this area of market is the fact that all of our cases are assessed on an individual underwriting basis. We have no set maximum loan size, and each case is assessed on its own merit. So, you know, we have a human there in an office underwriting all of your cases, which I think is really, really important, as it gives that common sense approach to all of the cases that we have. We don't have that computer says no policy, you know, that you might find on the high street. So I think that's really, really important, and what makes us great as a lender there. Where I was also based in our BDM support team before becoming a BDM, I built a great relationship with our team of underwriters. So I can easily, you know, call them up, have a chat through the case. If there's anything that that might be, well, you're going to be coming to us if it's slightly outside the norm, but if it's something that falls slightly outside, you think this is a good case that we should be doing, we can easily just pick up the phone to the underwriters and present the case to them and tell them why we should be lending to these clients. And our underwriters very much work against that approach. They really work to that, and they take all these little things into account, and then hopefully they'll be able to agree our cases for us. And then as soon as the underwriter supports their that case, that will then go through to completion, with their name held against that. We don't credit score for any of your clients. It will all be based on a satisfactory credit search. If there is a few bleeps in the credit report, we can usually look beyond that. What I would always say is just send us over a copy of the credit report, which especially you guys do that credit search for beforehand. Send it over to us. If there is anything that slightly falls outside of policy, I'd always say send it over and we can check it with an underwriter to see if they'd be happy to consider that. But usually, as a rule of thumb, you know, the odd mispayment on the credit cards, if there's any mispayments on utility bills, we can usually look beyond that. Defaults and CCJs below £500, as long as they're satisfied, can be considered. Anything above £500 does need to be settled for 3 years. But in terms of incentives that we would offer, we do offer free valuations up to 500,000 with a discounted valuation fee after that, and that's on all of our standard buy-to-let cases. So starting off with our standard buy-to-let, our core range of buy-to-let products. So it's maximum 65% loan to value for our buy-to-let mortgages at the moment. As I said before, we see a lot of our cases come from those clients that are looking to lend into retirement because we offer those longer terms for them, so up to age 94 on a buy-to-let basis. Maximum range for our buy-to-let clients is 89, and we'll do a 5-year term for them. Definitely one of our USPs for our buy-to-let lending is the fact that we don't ask for any income from these clients. We have no minimum income at all. All we want to understand is that these clients are able to cover 3 months mortgage payments if there was a rental void. So they might have employed income, self-employed income, or pensions, but they might not have any of that income at all. That's absolutely fine as long as they have savings there in the background to cover 3 months mortgage payments if there was that rental void. So it's unlikely that our underwriter will be asking for any evidence of this, but if they did, they would just want to see proof of that. I can only think of maybe 1 or 2 cases where the underwriter has asked for evidence, and that's because they've seen on the bank statement that the tenants haven't been paying the rent in full. But just for our security, we want to understand that if anything was to happen further, that those clients are still able to cover those mortgage payments. We do accept first-time landlords. We do ideally want them to be living and owning in their main residence. If they're not, then they will need to be party to the mortgage with someone that does. Let's say, I don't know, father and son. Dad will own his own main residence, but son's first-time buyer, first-time landlord. As long as they're both going on the deeds, then that's something we'd be able to consider for them. And again, another USP for us as well is we don't stress portfolio landlords at all. So all we want to see is a copy of their portfolio schedule, and that's just to cross-check that against the credit report. We won't be stressing those properties in the background, and there's definitely no limit on the number of properties that those portfolio landlords must own. We'll be really, really flexible there. They can either provide a copy of their own schedule, or we do have a form that you guys can complete if that's what you prefer to do. And as Tony mentioned previously, we do have exclusive fixed rate products available via specialist finance, so definitely utilise them. With our rental calculations, I've noted there what the stress rates will be. When putting it through specialist, it'll be assessed at pay rate, which will be a lot more generous to the affordability calculation there. And it's usually a 2 or 3 or a 5-year fixed rate, most definitely, that would be available at that time. So then moving on to our buy-to-let mortgages for expats. We have 45 different countries in total for our expat mortgages, and some of those I've stated there, so that includes Australia, South Africa, Hong Kong, America, and then we also cover, Europe and the Middle East as well. There are many, many more countries that we do cover. That is just only a handful there. The team at Specialist do have the details of the expat countries that we do cover, so certainly have a look into that. But we treat all of our expat clients the same as we would do with our UK residents. So it's the exact same rental calculation that would apply. It is no different. But I think sort of the main thing here for us is the fact that those clients are UK residents living and working overseas in one of our acceptable countries. If we look at, on the other hand, those foreign nationals living here in the UK, that is definitely something we can consider as long as they have permanent residency, or if they are EU nationals, they need to have settled status. And again, 5-year fixed rates available via specialist finance, which will be a lot more generous to the affordability calculation. Okay, so our limited company buy-to-let mortgages, this has recently just been revised. So we're just trying to approach this a lot more, and because I'm sure you'll all agree, it's something that we're seeing a lot more of at the moment. I think this is what the portfolio landlords are going to be going down a lot more, rather than just having these mortgages in their personal names. So it's the same loan to value that applies, so maximum 65% loan to value, but we do accept these mortgages in the absence of personal guarantees. So we aren't relying on them to be in place. However, if they aren't, then we will cap the loan to value at 55%. We say up to 8 directors and shareholders allowed for this, and they all have to be party to that mortgage application. And this is only available to those UK residents as well, just to note there as well. It is something we hopefully will approach later down the line, but for now, we're saying, you know, UK residents only. But this is the area of criteria that we've recently just revised. So we'd always say a brand new set up SPV, you know, maybe maximum 12 months. But we've now revised this to say that there is no time limit on that SPV to be set up, as long as it's been set up for the recognised SIC codes, so 68100 or 68209, I think it is off the top of my head. So as long as it's been set up specifically for renting out these properties, then that's something we're going to be able to consider without there being a time limit on how long that limited company's been set up for. And we say 3 properties accepted in it initially. If you do have a limited company that has 4, maybe 5 properties in it, I'm sure I can sweet talk the underwriters to see if they'd be able to consider it for us. But again, specialists have access to our semi-exclusive 5-year fixed rate via a limited company as well. So again, utilise that when looking at the rental assessment, and it'll be a lot more generous to the affordability there. And then lastly, in terms of the areas of lending for buy-to-let that we cover, we've got our offset buy-to-let mortgage product, and I think this is a great product. I think it's great for those portfolio landlords, you know, who are in a position to be able to buy a property outright, but instead they decide to purchase the property via a mortgage and then put the money into the offset savings account. You know, even for those self-employed clients who've got to pay a large tax bill, or those who want to get a better return on their savings. Savings interest rates aren't great at the moment, and it's definitely going to put that to much better use. So with our buy-to-let offset mortgage, it is available on interest only or repayment. And I think what's great with this is they can offset up to 100% of the mortgage balance, and they've got complete access to this offset savings account. So if they do need that money urgently, or they wanted to gradually draw down on it, they can absolutely do so. It will be in their account the following day. But with interest only, and if they did offset up to 100%, they wouldn't be making any mortgage payments at all. So definitely a great niche product there to utilise. And also family members can help with this as well, as we allow up to 4 savings accounts to be linked to the mortgage. Again, with complete access to it, they're not tying up that money for a period of time. They've got complete control over it, and they can dip into that fund as much as they please. Okay, so then just to quickly touch base on the other areas of lending that we do cover on a residential basis, just in case you guys do specialise in these at all. So it's maximum age of 95 on a repayment basis for our residential mortgages, and 94 on interest only with term guidelines. Interest only is maximum 70% loan to value for downsizing, and with that there's no barrier to entry, so there's no minimum income, no minimum equity or minimum property value that is required. All the underwriters want to look for on this basis is a possibility for them to comfortably downsize within a 5-mile radius. We would consider up to 75% loan to value on an interest-only basis as well if they have an alternative repayment strategy in place, for example, sale of a buy-to-let property. We consider joint borrower sole proprietor, again taking parents to age 95 there on a repayment basis. We've got a 95% family mortgage, and this works similar to the Barclays Springboard mortgage actually, where we need additional security. But rather than just asking for savings, we also accept a charge on a family member's main residence. And we also have expat residential products as well, again, covering those countries that I said earlier. But we can also accept foreign currency income as well, as long as it's made up as employed or pension income. And then we also have an offset residential product as well. So it works in a similar way, but it is just on a repayment basis. So that is the details there. And so if you do have any cases that you have in mind, certainly give the team at Specialist a call. They're a wonderful team. I love working with them, and they'll definitely be able to help you. But if you did want to contact me directly, that is the best contact number to get me on. And just quote Specialist Hub, and I will be able to help you with that. And we can also look at the rates and products that the team have access to there.
Grace, absolutely fantastic as always. I've got to say one thing about Grace. Last year, when lockdown was happening, she was probably the most proactive of all the BDMs that we deal with. She was absolutely superb. You know, I mean, we've all got stories about. I'm still waiting on a call back from 2 weeks ago from one BDM on a case that was for 2.3 million, and he's still not phoned back. I've rung him 4 times. If that had been great,
you wouldn't be getting that with me, I must say.
Yeah, with Grace, you'd have been back within 5 minutes, literally, and then 10 minutes later, phoning me to find out where the case was and why I hadn't submitted it. Right, got a couple of questions. So there was one question from Paul. I think you covered that. How old at application, which was 89 on the buy-to-let side. Terry James has asked, will Family Building Society consider holiday lets?
Unfortunately, we can't consider holiday lets. I'm hoping that it's something we eventually do approach, but at the moment it's just holiday homes, unfortunately.
Okay. And Zoe has asked, in terms of the expat mortgages, do you accept expats residing in Dubai with a buy-to-let in the UK?
Yes, we do. So as long as they've got that buy-to-let property here in the UK, ideally with a mortgage on it, and then yes, we can definitely consider those expats living in Dubai. Okay.
Is the questions that you set yourself earlier, Grace? So make sure you get these right, by the way. What do you need to support the application for portfolio landlords?
We don't need, all we need is just their copy of their portfolio schedule, or if they wanted to, they could complete our form as well. That's all that we would need.
Okay. The second question has already been answered. It's one of the delegates asked it, so I won't bother asking that. Just so you know how good we think Family Building Society are, I've got 4 children, 2 of whom are currently in the process. Grace hasn't seen these yet, but in the process of getting together what they need to apply for a Family Building Society mortgage using their. They're very generous. My son is, fortunately, his fiance is comes from a very wealthy family. She did private school in Scotland, so I don't have to get involved in that one, thankfully. But my daughter's one, I might have to get involved unless I can talk my son-in-law's parents to offer up their unencumbered property as security. So I'm still working.
Help the other one out too.
Yeah. So,
brilliant.
Yeah. And that's for the 2 younger ones. They can wait. So yeah, that may well happen very soon. So, but honestly, if you've not used Family Building Society before, they got some fabulous products. And Martin's asked, does Grace cover ER too? I'm not sure where ER is, Martin. ER?
I think it's equity release.
Equity release, right? Okay.
But we act as an alternative to equity release because of the longer terms that we can offer on a repayment and interest-only basis. So usually, we'd be able to satisfy that there and help them on an interest-only basis, given the longer terms that we can offer them.
Sorry, what's going on with me today? I thought ER stood for emergency room, to be honest with you. I got very, very confused there, so apologies, Martin. I didn't understand what you were asking. So, Grace, absolutely fabulous. Keep up the good work as always.
Tony.
Can't wait to meet you in person when all this is over. So
it won't be long.
Yeah, very soon. So you take care of yourself. Okay.
Yeah,
that
you
was
too,
great.
Tony.
Thank you.
Take care. Bye-bye.
Thanks. Bye-bye. Next speaker, Richard D'Souza from MFS. As you can see, that's not a lockdown hairstyle he's got at the moment. That is his normal haircut. So there you go. There you go. Okay, so everyone, you should have received via email today the intermediary lending guide for 2021. If you haven't got it, if you haven't received these today, email me or one of the team and we'll get these over to you just so you can see. You'll be able to read these afterwards, obviously. But this is the bang up to date intermediary lending guide from MFS. So a little bit about Richard, first of all. Richard joined MFS in 2017 as an underwriter and is now a senior underwriting manager. Previously worked for I hate the term master broker, the loans engine for 12 years as a second charge mortgage underwriter, and so has a solid 16 years experience in the industry. Like many, Richard fell into finance through a recommendation through a friend, and in fact joined MFS in much the same way. Richard is passionate about the experience brokers receive when they work with MFS, placing importance on speed, but also the ability to really understand the client's requirements. He understands that the market is saturated with lenders, so understanding and being able to find solutions to problems that others can't find is his goal for every deal. I really got to say, I mean, pretty much everyone we deal with at a lender who's got previous broker experience makes our job so much easier at times, because they know what it's like to be a broker. So keep it going, Richard. Keep it going. Okay, this is now this one I should have actually put a, not I'm going to say wealth warning, but your health is at risk if you follow this guidance. Okay, Richard adds copious amounts of ghee to his coffee. If you haven't tried it, this is Richard's words, not mine. You should. That's my disclaimer. If you try it and anything happens, don't blame me. But that's an unusual one. I might give it a go, maybe sometime. I'm not sure. But my ghee's in the fridge, so it's solid. So I'm not sure how that's going to work. But anyway, okay, Richard, it's over to you. I'll see you in about 20 minutes.
Great stuff. Hi, I'm Richard. I'm the underwriting manager over at MFS. I'm here to talk you through bridging finance, and in particular development exit loans, and how we can help your clients' projects. So who are MFS? So we're a bridging lender. We've been around for a very long time, since 2006. So for us, bridging finance, speed is absolutely key. We can complete loans in as little as 3 days, but typically we would say your average would be 7 days. As a lender, we're always transparent. So there's no hidden costs for your borrower. Back ends, we're always upfront with fees, interest rates, exit fees, etc., right from the outset. So we love complex scenarios. We've got multiple funding lines. We've got 8 funding lines at the moment, and we don't have a tick box criteria, which basically allows us to be creative, flexible, to find a solution for your client. So what is bridging finance? It's basically short-term finance secured against an asset to bridge a gap. It is typically more expensive than a long-term buy-to-let lender or product, but there are quite a few scenarios where bridging finance may be the best option for your client. So the first one would be auction purchases. So typically when you exchange at an auction, you have 28 days to complete. The borrower needs to put down a 10% deposit when he exchanges, and if he doesn't complete within 28 days, he then loses that deposit. So typically where we would come into play, I mean, like I said, our average turnaround time is 7 days. Buy-to-let mortgages at the moment are taking 3 to 4 months. So if he went down the buy-to-let route, then he wouldn't complete in time. So we would complete the purchase with a bridge, which would then give him flexibility to find the right product after the completion has taken place. Another scenario would be if they're looking to purchase a property, however, they need to sell an existing property before the purchase can take place. So if they're in some sort of chain. So in that sort of scenario, we could help with the purchase. We could even take a charge on one or both of the assets if needed be, depending on the loan amount required by the borrower. And then what that then gives the borrower is a little bit of time to then sell the property at the right price, rather than being forced into selling the property at a cut price just because they have to complete the purchase on the property. Third scenario would be if there's an existing debt on a property they already currently owe, and the lenders decided that they want to call the loan in which case sometimes they can they can even instruct receivers within a month of giving the borrower notice. Like I said, it sometimes takes like 3 to 4 months to source a long-term product. In which case the borrower hasn't got time, otherwise the property could potentially be repossessed. So we would come in, take the existing lender out with the bridging finance, and then it gives the borrower a little bit more time to source the correct product or the cheapest product. So obviously with COVID things are slightly different, but we are progressing all the time. Just want to note a few things that we've recently seen from brokers that have actually approached us. So timescales are tight, especially with the stamp duty deadline, and alternative finance is being seen as a lifeline. A lot of banks since March last year, when we were locked down, have just completely tightened up criteria. I mean, over at MFS, we carried on lending through the pandemic. We never stopped lending, but I know a lot of the high street banks, etc., did pull a lot of their products. There's a huge demand for property for rent as well, especially in rural areas. People are moving out of London and Manchester, and deposits are hard to save for. All of which has basically created a buy-to-let surge. So now is a good time to bolster portfolios, seeing that there's a huge demand for rental properties. So essentially, the thing that people don't have is time. I've mentioned a few times, it's typically taking 3 to 4 months to complete on a mortgage, and banks are just completely overwhelmed with applications, especially with the stamp duty holiday. One thing is the property developers have also been hugely affected, which is why what we've done now is launched a new product, a development or dev exit product. The good news is, well, we've also just secured a £200 million funding line, which is obviously there to help this issue. So what is development exit? So typically, a developer will take out a development loan to build a property from scratch. They might own a little bit of land. A development lender will come in, lend them the money for the build costs for the projects. But once the works are finished, the developer will then need to either sell the properties off for a profit to repay the current development loan, or refinance them. So what's happened recently is with the COVID, COVID came in like last year, it's caused extreme delays with completing works on developments. But however, the lender has now decided they want the money back, and the properties are either not finished yet, or they've just been finished, but the properties are still on the market, or the developer's still trying to source a long-term product. So that's where we will step in. Once the property has building regulation sign-off and practical completion in place, we can then step in, lend them the money to take out the existing development lender, which will typically give the borrower another 12, 18 months to then sell the properties at the right price or refinance onto the right product. So just a quick case study then. So a property developer approached us last month through a broker. He had completed, the developer had completed 4 apartments in London. They were worth combined £10 million. Development lender had a debt slightly above 7 million, and they had called the debt in. And the properties were just finished. They were just going to go ahead and instruct the receivers. They gave the borrower a 2-week deadline. So we issued the terms at 75% loan to value, so £7.5 million gross, which gave them enough to take out the existing development lender. They already had a valuation report carried out through Savills, which we could then just readdress. We're happy to use the existing valuation. We didn't need to instruct our own one. We could use Savills' report, and we completed the transaction within 2 weeks, so it just gives the borrower a little bit more time now. The plan is to sell the properties. They're all on the market. So once the properties are sold, then we'd be repaid. So just to go over products and rates. So I've popped the table up here. We can lend up to £30 million. We can potentially go above £30 million on a referral basis. Our minimum loan is £100,000. As you can see, we lend up to 75% loan to value. Rates start from 0.59% per month. We typically pay prop fees 1 to 2%, depending on the level of volume the broker is bringing in, so it's negotiable. You can see we've got a wide range of properties that we actually lend against. So you've got your commercial, semi-commercial, standard residential buy-to-let portfolios, development exit products on there as well. We can do a little bit of light to medium refurb as well. One thing I think that sets us apart from other lenders is we do all the underwriting up front before we've asked for any valuation fee or any commitment from the borrower. So we'll ask a little bit more information up front than a lot of other lenders do ask for, but we want to, when we're issuing our terms, they are credit backed. So we've taken the deal through to credit committee, it's been approved. So typically the only thing that would cause us to change the rate is if the property down values. But like in the previous scenario, if they've already had a valuation carried out, we can potentially use that valuation, and that will negate that risk as well. So yeah, just if you've got any case at all, feel free to just contact us and we'll run through it with you. So for more information on finance, bridging loans and what they can be used for, more case studies, all the good stuff, you can check for our website. We do regular research into sentiment around property investment, current trends, so you can read about that. We also do blogs, weekly blogs, and we also add our case studies to the website. So there's also all different kinds of scenarios outside of development exit. So for now, that's all from me. I will be sticking around to answer any questions you might have, bridging related, and I'll do my best to answer those. You can get in touch if you email me directly on, my email address isn't up there, it's richard@mfsuk.com, or you can call me directly on 07508 148 174.
Richard, thank you very much. We got one question which I think I can probably answer, which relates to. So, if Paul, if it does, MFS aren't in the regulated space, but they are if it's regulated. I think that might refer to regulated. That question, so it's not their bag. But
yeah. So we can lend on a residential property on a second charge basis for business purposes. So if it's their main residential, we can't do a first charge, but we can, if there's already a first charge in place, we can do a second charge behind that. But we don't offer regulated, it's unregulated products only.
Okay, fine. Paul Rhodes also mentioned ghee with a question mark. Just to be aware, if you haven't got any ghee in your fridge, please don't substitute it with goose fat, flora, or any other sort of like cooking material, because I'm having trouble with the ghee part at the moment, but I might still try it just to see what it's like. But yeah, please don't start bunging goose fat or butter in your coffee, because yeah, not good for your health, I suppose. Some of the questions that have been set by you, Richard, but I expect you being underwriting manager, you know the answers to these anyway. Do you do adverse?
Yeah, so we can do a limited adverse. as long as we are clearing off all the adverse, we're not overly concerned that the borrower has adverse, as long as he's clearing it off. So we've completed bridges where borrowers have had bankruptcy charges, where we're putting them in a better position. CCJs, defaults, mortgage arrears. Not overly concerned about mispayments on credit cards, but if there is any sort of adverse CCJs, defaults, mortgage arrears, bankruptcy charges, we can lend. We just need to clear them off with the proceeds of the loan.
Okay, what do you ask for in terms of fees?
So typically, the borrower will pay a 2% arrangement fee, but it is negotiable. But that would be our typical fee. Borrower will need to pay a valuation fee. That's subject to property value, property type, etc. They'll need to pay a commitment fee. We always do commitment fee depending on the loan size. We're always happy to refund the commitment fee as long as we haven't started the legal process. So, for example, if the valuation comes in lower than anticipated and we can't lend full stop, I'm happy to just refund that commitment fee back as long as we haven't instructed the legal process. So we're quite flexible on that. Yeah, that's pretty much. We don't charge any exit fees. So it's a minimum term of 3 months, but there's no exit fees. I know a lot of other lenders do have an exit fee.
Okay. And if it's limited company lending, do you require PGs?
Yeah, so we require a PG. It's typically 100% PG, loan amount. However, with the larger development and exit products that we've said, the PGs are going to be negotiable on those, potentially 25% PG, but we will require a PG.
Okay. All right, the final question I've got, unless anyone's got any more, is can you lend on a derelict building? Unfortunately
not. We have, if it's just a derelict building alone, it's no, but we have structured it in a way, I think I mentioned you before, we have multiple funding lines. So if, for example, the borrower is providing the derelict property as security, but he's also given us a couple of buy-to-let properties or a commercial property, then we may be able to consider it as a whole, but not on its own.
Okay, right, no more questions from the delegates. Richard, thank you very much indeed. That's the first time you presented on one of ours, but that was absolutely great. It's always good to actually hear from somebody who's at the sharp end, actually underwriting the cases and seeing what's going on a day-to-day basis. So, and this is the guy we have to keep happy. We are an accredited packager for MFS, so we get paid increased prop fees. So you get paid the same if you come through us as you would do direct. So if you do have something you think will be a potential case for MFS, run it past us. We'll speak to the team and we can see if we can get your terms out. But Richard, great stuff. Thank you very much indeed.
Thank you, Tony.
I will speak to you soon.
Thank you. Cheers.